Hi, this is Professor Cataldo. I'm going to go through some adjusting journal entries, how they would made and how they map onto a trial balance worksheet. Very broad brushstrokes. This is the type of material covered in an introductory financial accounting course, usually around Chapter 3. If you have not seen them and you're weak on the steps in the accounting cycle, please see my PowerPoints on the unadjusted trial balance before you proceed. This is the accounting cycle. I'm going to very quickly go through step 1, 2, 3, and 4, and I'm going to focus on step 5. These are the adjusting journal entries that you would make to an unadjusted trial balance. So you first analyze transactions, decide what journal they need to be stored in or summarized in. You record them in the journal. At the end of the month, you take those summary totals and post them to the general ledger. You use the general ledger to prepare an unadjusted trial balance. And then item number 5, you make adjusting journal entries to adjust those trial balances and prepare an adjusted trial balance. Once you have an adjusted trial balance, you can prepare your financial statements. These are the journals: cash receipts, cash disbursements, sales journal, purchases journal, general journal. This merely illustrates that you take summary data, a big journal entry if you like, for the entire month, for the cash receipts, the cash disbursements, the sales, the purchases, the general items, and you post them or transfer them to the general ledger. Once you have posted them to the general ledger, you have the starting point. You have the unadjusted trial balance from which you will prepare financial statements. Now, this is an example of adjusting journal entries, and I'm not going to have you dwell on where they came from. Instead, I want you to focus on the mechanics, just the debits and the credits. At this stage, you should have the debits and credits down. Let's see if you do. If you are unable to follow what I am saying right now, then you're weak on your debits and your credits, and you need to go back and fix that before you proceed. Let's see. Item A, I have insurance expense debit. That's an increase in an expense in my income statement. And I have a credit to prepaid insurance. Under the matching principle, I am going to assume that the firm has consumed $100 worth of their prepaid insurance. Prepaid insurance is, of course, an asset account, and a credit to that account reduces its carrying value or balance. B, supplies expense debit. That's an increase in an expense account. Supplies, now I put inventory in brackets. If you ever see supplies in a textbook and it does not say supplies expense, assume it is supplies inventory. It's an asset. So supplies expense debit, that's an increase in the expense. Supplies inventory credit, that's a decrease in an asset. You know what? I probably took a physical count of supplies inventory at the end of the month, and I found out I had a certain amount on hand, and when I knew how much I had on hand and how much I'd previously purchased, it was a simple matter for me to compute the amount that I had consumed during the period. Depreciation expense, item 3. Let's see, I'm debiting an expense, increasing it, and accumulated depreciation. That has not been introduced. It's usually introduced around Chapter 3 of a text. That is a contra asset account. It's merely the depreciation that I have accumulated on that asset over time. That's why it's called accumulated depreciation. So I increased an expense, and debits have to equal credits. So mechanically, I have developed a contra account, contrary to a contra account, which is increased with a credit, and that account is called accumulated depreciation. So I've consumed, based on estimates of economic and functional obsolescence over a period of time, I've assumed that I'm consuming that fixed asset over time. It's wearing out. It's becoming economically or functionally obsolete. Item D, unearned revenue. Someone walks in and they write me a check and they prepay me for work I have not yet performed. It's not inconceivable they could come back the next day prior to the performance of any work and say, you know, I changed my mind. Give me my check back. So that unearned revenue, where they prepaid me for work that I have not yet done, that's a liability until I earn it. It looks to me like, let's see, unearned revenue, a liability. I'm debiting that, so I'm reducing the liability, and I'm crediting a revenue account, consulting revenue. It looks like I probably earned $250 of whatever amount they gave me, it doesn't really matter, over the period. Item E, salaries expense. That's a debit to an expense, so it's an increase. And I'm booking an accrual, a liability, salaries payable. Remember, all receivables are assets, all payables are liabilities. So I must have estimated, it looks like the end of the month does not fall on a payday. That would make things simpler. So I have to accrue or book the payable. So I have an increase in an expense and an increase in a liability. And of course, when I write everyone's paycheck, that liability will go away. Finally, item F, accounts receivable consulting revenue. It looks like someone came in and I went ahead and extended credit to them, and I generated and earned some consulting revenue, $1,800 worth, and I, of course, booked the accrual. Now, don't get bogged down in the mechanics of each of these items, although they are usually covered in Chapter 3 of an introductory financial accounting course. I want you to pay attention to the debits and the credits and the mechanics. If you are able to understand what I said, you don't understand where the numbers came from. But if you are able to understand the debits and the credits, you're in pretty good shape. We can go ahead and cover the computations and show you how the numbers were computed at a later point. Notice the debits and the credits equal $37.85. These are my adjusting journal entries. This is my unadjusted trial balance with the adjusting journal entries, as previously noted. So there's adjusting journal entry A, B, C, D, E, F. Notice at the bottom, the same total, $37.85, debits equal credits for the adjustments. I have an unadjusted trial balance. I have the adjusting journal entries I used, and now I'm going to extend those numbers to the next two right-hand columns, and I'm going to arrive at what's referred to as an adjusted trial balance. Thank you.